This is Janet Yellen. She once stared down a financial crisis as Federal Reserve Chair. She guided the United States economy through the post-2008 recovery, overseeing a period of low unemployment and gradual interest rate increases from near-zero levels. Her decisions rippled across the globe, affecting stock markets in London, factories in Shanghai, and farmers in Brazil. The Federal Reserve holds immense power to shape the global economy. This power comes from controlling United States monetary policy, managing the dollar as the world's reserve currency, and stabilizing financial systems during crises. In 1907, a banking crisis shook America to its core. Knickerbocker Trust, the third largest trust company, collapsed, sparking panic. People rushed to withdraw savings, but banks, holding little cash, failed one after another. Businesses crumbled and the economy teetered. Wealthy bankers like J.P. Morgan stepped in, using personal funds to bail out failing institutions. This reliance on private wealth exposed a flaw. America needed a stable system, not individual heroics. In 1913, Congress responded with the Federal Reserve Act, creating the Federal Reserve System. Designed as a central bank, it aimed to prevent such chaos. The Fed was created to bring order to the banking system. 12 regional banks were established, from New York to San Francisco, to act as a bank for banks, providing emergency cash to stop runs. This structure spread power across the country, easing fears of a single, overly powerful bank. The Federal Reserve was tasked with managing currency and ensuring financial stability, but its role was about to grow. The Board of Governors in Washington, 7 members appointed by the President, oversaw the system, while the Federal Open Market Committee managed key operations. The Federal Reserve operates with 3 core components. The Board of Governors sets monetary policies, like adjusting interest rates or printing money. The Federal Open Market Committee, including 5 bank presidents, handles open market operations such as buying or selling government bonds. The 12 regional banks create a sense of decentralized control, though the board holds ultimate authority. In 1913, the Federal Reserve Act established 2 principles. The Fed is a private, independent entity, free from direct government control. It is also the sole issuer of United States paper currency, while the government mints coins worth $1 or less. The Federal Reserve wields 3 powerful tools. First, it adjusts the federal funds rate. Lower rates encourage borrowing and hiring when unemployment spikes. Higher rates curb inflation by pulling cash from circulation. Second, it regulates reserve requirements, dictating how much cash banks must hold, which shapes lending. Third, open market operations allow the Fed to buy or sell government bonds, injecting or withdrawing liquidity. These tools give the Fed precise control over America's economic pulse. July 1944, world leaders met at Bretton Woods, establishing the United States dollar as the global reserve currency. Countries pegged their currencies to the dollar, and the dollar was backed by gold. The Federal Reserve, managing this currency, gained massive influence. Federal Reserve notes in circulation reached $2.255 trillion, backed by Treasury securities and mortgage bonds. Every dollar printed or rate adjusted by the Federal Reserve affects global trade, debt, and investments. When the Federal Reserve raises interest rates, borrowing costs climb worldwide. Rate hikes to fight inflation strengthen the dollar, forcing countries like Japan to adjust their own policies. This domino effect shows why the Federal Reserve decisions in Washington echo in markets from Tokyo to São Paulo. In 1978, Congress gave the Federal Reserve a dual mandate: stabilize prices and maximize employment. These goals often clash. Fighting inflation can raise unemployment, while boosting jobs can spark inflation. During the 1970s, inflation soared to nearly 15%, driven by bad policies and misfortune. Arthur Burns, Fed chairman, faced pressure from President Nixon to keep rates low before the 1972 election. This delay fueled price surges, eroding savings and destabilizing global markets. The lesson was clear: Political interference led to economic disaster.
Prices soared over 50%.
Gas prices skyrocketed.
In 1979, President Jimmy Carter appointed Paul Volcker as Fed chairman. Volcker raised interest rates to nearly 20%, a drastic move. Unemployment surged past 10%, and protests erupted. Home builders mailed wooden beams to the Fed, pleading for relief. Car dealers sent keys, symbolizing unsold vehicles. Farmers drove tractors around Fed headquarters. Yet Volcker's tough stance worked. Inflation fell, and the economy stabilized. Over the next 30 years, America outperformed most advanced economies, proving the value of an independent Fed. In 2008, the financial crisis tested the Federal Reserve again. Chairman Ben Bernanke, learning from the Great Depression, acted boldly. The Fed dropped interest rates to near zero, a historic first. It loaned money to non-banks and bought mortgage securities to pump cash into the economy. These moves, unthinkable before, prevented a second depression. The crisis earned the name Great Recession, a nod to Bernanke's success. The Federal Reserve also set up currency swap lines with foreign central banks, ensuring dollars flowed globally. Congress also expanded the Fed's role through the Dodd-Frank Act, granting oversight of the banking system. This crisis response expanded its role, making it a global firefighter. The COVID-19 pandemic halted economies worldwide. The Federal Reserve, under Jerome Powell, revived its 2008 playbook. It slashed rates to near zero, bought massive amounts of assets, and lent to non-banks. Its balance sheet hit $9 trillion. Social media memes joked, "Money printer go brer," capturing the scale of money creation. These actions stabilized markets, but they also fueled inflation, hitting 9% in the United States. The Fed raised rates from 0% to 5.5% by 2023, the highest since 2001. The Federal Reserve's independence is another reason for its power. Unlike elected officials, its leaders can make unpopular choices without voter backlash. This freedom lets it act decisively, as seen during crises, but it sparks criticism. Some argue unelected officials shouldn't control such vast economic levers, especially when decisions affect billions globally. Silicon Valley Bank collapsed, threatening a banking crisis. The Federal Reserve stepped in, guaranteeing deposits and lending to banks. This quick action prevented a global ripple effect, as European and Asian markets watched nervously. The Federal Reserve's role as a lender of last resort makes it a linchpin of financial stability, trusted by markets worldwide. The Federal Reserve also runs payment systems like FedWire, handling trillions daily, and FedNow for instant payments. These systems keep global finance flowing smoothly. Its data, like the FRED database with 826,000 time series, shapes economic policies from London to Beijing. The Federal Reserve bailed out big banks, sparking accusations of favoring Wall Street over Main Street. Critics on platforms like X claim this created moral hazard, encouraging risky behavior. Others argue the Federal Reserve's focus on markets ignores workers, pointing to recessions when Volcker's rates crush jobs. These debates highlight a tension. The Federal Reserve's power saves economies, but fuels distrust. President Trump's tariffs raised fears of inflation, putting the Federal Reserve in a bind. Chair Jerome Powell noted uncertainty, holding rates at 4.25 to 4.50%. If tariffs push prices up, the Federal Reserve may hike rates, slowing global growth. This shows how its decisions, even in response to politics, shape the world.